All right, let's talk about something we've all dealt with, medical bills. And that inevitable question that follows, can I please get a tax break for this? Well, the answer is complicated. It's buried in one of the trickiest parts of the U.S. tax code, Internal Revenue Code Section 213. Now, you'd think it's there to give us all some relief, right? But as we're about to find out, actually claiming this deduction is a whole different ballgame. It's surprisingly tough.
So here's our game plan for today. First up, we're going to run the medical expense gauntlet, and trust me, it's a real challenge. Then, we'll get into the nitty-gritty of defining what medical care even is in the eyes of the law. After that, we'll dive into a really fascinating court case that put that very definition to the test. And finally, we'll wrap up with a look at the alternative minimum tax and how the rules work today. Ready? Let's jump in.
Okay, first things first. You have to understand that this deduction isn't some kind of automatic right. No way. The courts have a term for it, legislative grace. And that's basically a polite, legal way of saying Congress could have given you a break, but they decided to make it really, really hard to get.
In this quote right here, this gets to the heart of it. It's designed as a catastrophic coverage provision. So, think of it this way. It's not for your yearly physical or a bottle of aspirin. Not at all. It's for those massive, unexpected medical events that could literally wipe you out financially and make it impossible to pay your taxes. It's an emergency brake, not a cruise control for healthcare costs.
And this number, 7.5%, this is the single biggest hurdle you have to clear. This is what we call the AGI Floor. AGI stands for Adjusted Gross Income, and what this means is you can't deduct a single penny of your medical expenses until they add up to more than 7.5% of that AGI. Let's put that in real numbers. If your AGI is $100,000, your first $7,500 in medical bills, they get you absolutely nothing in terms of a deduction. It's only the amount you spent over that line that even begins to count.
Now this is where things get really interesting. Check out this table, because it shows how your job status can completely change the math. On the left, you've got a regular employee. They make $100,000 and they pay $10,000 for health insurance with after-tax money. Their AGI is still $100,000, so they have to get past that $7,500 floor, meaning only $2,500 of their premiums are even potentially deductible. But now, look at the self-employed person on the right. Because of a different rule, IRC Section 162L for you pros out there, they get to deduct that entire $10,000 premium above the line. That means it lowers their AGI before the 7.5% floor is even calculated. It's a total game changer, a massive advantage built right into the code.
Okay, so let's imagine you actually made it. You've jumped over that huge AGI hurdle. What's next? Well, now we hit the second big question. What exactly does the IRS consider to be medical care anyway? This is it, folks, straight from the source, Section 213D1. The keywords here are diagnosis, cure, mitigation, treatment, or prevention of disease. That seems straightforward enough, but then you get this kicker at the end, or for the purpose of affecting any structure or function of the body. Now that is some incredibly broad language, and it's the part that opens up this whole can of worms and leads to all sorts of debates.
So the tax code basically creates two different buckets. In one bucket, you have your non-deductible personal expenses. This is stuff that's just for your general health and well-being, like a gym membership or organic food. The IRS says, nope, that's a personal choice, and they point to Section 262 to back it up. But in the other bucket, you have qualified medical care under Section 213. This isn't about general wellness. It's about targeting a specific physical or mental problem. It's the difference between routine maintenance and an emergency repair.
Now, Congress really wanted to draw a hard line on cosmetic surgery. The general rule is simple. It's not deductible. Period. But, and this is a huge but, there's a very specific exception. A procedure stops being cosmetic for tax purposes if it's needed to fix a deformity from a congenital abnormality, a traumatic injury, or a disfiguring disease. Keep that little detail in your back pocket, because it is absolutely crucial for what's coming next.
All right, so we've talked about all these abstract rules and definitions, but what happens when they collide with a real person's life? Well, that's exactly what we're going to see in our case study, a landmark legal battle that put these definitions under a microscope and forced the court to make a very tough call.
The case is called O'Donovan v. Commissioner, and it's a big one. At its core, it boiled down to one question. Could the costs for gender confirmation surgery be deducted as a medical expense? And to answer that, the tax court had to grapple with some incredibly fundamental questions. What is a disease? What qualifies as a treatment? And where is the line between a medical necessity and a cosmetic procedure?
So, here's the setup. The taxpayer, Rhiannon O'Donovan,
was formally diagnosed by her doctors with gender identity disorder, or GID. Based on that diagnosis, she followed a prescribed medical treatment plan, which included surgery. She then did what she thought was right and deducted those medical costs on her tax return. But the IRS disagreed. They disallowed the deduction, and that's what kicked off the court battle.
So O'Donovan's legal team built a really straightforward case, basically just connecting the dots from the law we just went over. Their argument went like this. Point 1, gender identity disorder is a medically recognized disease. Point 2, hormone therapy and surgery are the established, accepted treatments for this disease. Point 3, these treatments directly mitigate the disease and absolutely affect a structure or function of the body. And finally, because these procedures are treating a diagnosed condition, they are by definition not cosmetic, they're therapeutic. It's a pretty clean argument.
The IRS, on the other hand, came back with a much narrower, you could say a more creative interpretation. First, they argued that GID isn't a disease in the way they defined it because there wasn't a known organic pathology, basically a problem at the cellular level. They also flat out called the procedures cosmetic. But then they went even further. They tried to add new tests that aren't actually written in Section 213, claiming the taxpayer had to prove the treatment was medically necessary and wasn't controversial in the medical community.
So who won? Well, it was a split decision, but the court largely sided with O'Donovan. The judges agreed that GID is a disease for tax deduction purposes. They also agreed that the hormone therapy and the genital surgery qualified as medical treatment under Section 213. But they drew a line. They decided that the breast augmentation was, in their view, cosmetic and therefore couldn't be deducted. So it was a landmark ruling that said yes, treatments for GID can be deductible, but it also made it clear that every single procedure can be looked at separately.
Okay, let's bring this home with the final piece of this very complicated puzzle. For a long time, even if you managed to clear every single hurdle we've talked about, there was one last monster waiting for you at the end, the Alternative Minimum Tax, or AMT. You can think of the AMT as a whole separate parallel tax system with its own set of rules. And here's the killer part. For medical deductions, the AMT had an even higher AGI floor, usually 10%. So you could do all the work, qualify for the deduction on your regular tax return, and then, poof, the AMT calculation would just snatch it right back. It was like running the gauntlet twice. The good news? Congress eventually fixed this mess, and now there's just one set of rules, which makes life a lot simpler.
So after all that, how do we apply this in the real world? Here's a practical 3-step framework for any professional looking at this deduction. Step 1, verify. You've got to confirm that the expense actually meets that strict Section 213D definition and isn't just a personal expense. Step 2, timing. This is crucial. Was the expense paid in the tax year? It doesn't matter when the service happened, it only matters when the cash left the bank account. And finally, step 3, calculate. Do the math. Figure out the AGI, apply that 7.5% floor, and then ask the most important question. Is the number you're left with even bigger than the standard deduction? Because if it's not, you've done all this work for absolutely zero tax benefit. If you can nail these 3 steps, you can confidently navigate this incredibly tricky part of the tax code.